Time for our weekly strategy session, and joining us from Cape Town today is Peter Brooke. He's head of the Macro Strategy Investment Boutique over at Omigsa. Peter, a very good afternoon to you. You put out a release this week saying it's time to diversify offshore, giving a number of very good reasons for that. The Rand, though, you say the Rand could weaken this year, but your own economist at Omigsa, Rian Leroux, says the Rand is one of the most unforecastable factors in the South African economy. Take us through the factors why you think we should be diversifying more offshore.
I think that's completely right in terms of the unforecastability, and we don't even bother trying. We look at it rather in terms of where is the long-term value of the Rand, and right now it looks expensive. So over our investment time horizon, which is 5 years plus, we think it will weaken, therefore it should boost returns. But when we think about diversification, and it's really relevant today because we've seen the Reserve Bank has increased the amount that pension funds can take outside of the country from 20% to 25%, we look at three different factors. The first is diversification, the second is valuation, and the third is the currency.
Just looking at that diversification, because you don't want to take all of your cash offshore, what sort of percentage would the average investor want to take offshore if they don't already have cash offshore?
I think every individual is different and in terms of their different life stages. So let me answer it for a balanced fund, which is your typical savings block for most people in the country. And when we model that, we're trying to get a real return of around inflation plus 5%, and we plug that into the back history and it comes up with international assets of a bit north of 35%. So really with the levels at 25% now, it's fairly simple to say that you should take more money offshore. So 35% plus is a typical number, but the difficulty is every individual is different. So if you, for instance, very old, you've got local bills, you don't have time for your assets to grow, you probably want to be a lot more matched into South African assets and South African income-bearing assets.
What sorts of returns would you expect on those international assets compared to South African assets over the medium term?
Well, we still think that international cash is absolute trash. Rates, even with an uptick in cycle, will still be kept low, and your real return on developed markets like England, the UK, the US, Japan are going to be negligible, so nothing. So SA cash will still be better. We still don't like international bonds, but international equity looks reasonably valued. And relative to South Africa had a stunning year last year. In fact, in US dollar terms, it was one of the best performing markets in the world. So the relative valuation is starting to shift towards offshore equity relative to South African equity.
Well, you talked about the returns in South Africa last year. In local currency terms, we increased by about 20%. Total returns in dollar terms, though, up by north of 30%. So pretty good returns there. Any chance of repeating those this year?
I'd be very surprised. If you look at the PE multiple, the price earnings on the market is over 17 times. And that's fairly high by historic standards. Now, you can have that when you expect good earnings growth, and we do expect good earnings growth, but even plugging that in, you need years and years of good earnings growth. So our expectation is good earnings growth will give a reasonable return and a bit of a derating in the market. So we wouldn't expect as good a returns this year as we've had last year, and particularly for interest-bearing assets. You know, bonds did 15% and listed property did nearly 30%. We think that's very unlikely because we don't expect rate cuts this year. Last year we had the benefit of 1.5% of rate cuts, which led to a capital gain from interest-bearing assets. We don't expect that this year.
How do our PE multiples compare to the PE multiples of developed markets such as the UK and the US?
When we look at it on a forward basis, and particularly 2 years out, we still look reasonable. So emerging markets are a bit cheaper than developed markets, and within that South Africa is about average. But historically we used to be cheap. So just a simple example, if you look at our dividend yield versus the Japanese dividend yield, 30 years ago you got 8% more dividend yield than investing in South Africa than you did investing in Japan. Today you're getting less than 1%. So we're much more reliant on growth and on capital change for our returns relative to those markets than we used to, which makes it less certain So the probability of outperformance has decreased.
Well, Peter, you mentioned Japan as a potential investment destination, looking at equities in that country, but that market has underperformed for years. In fact, for the last 30 years, why would this year be any different for Japanese equities?
I think it's, if you keep on underperforming, you eventually become cheap. And the market knows all about Japan's problems. I mean, yesterday we had the S&P downgrading Japan's credit rating. It's typically rating agencies are behind the curve. It's telling you what's happened. So I wouldn't be concerned about something like that. It's really a function of it's derated. The currency's been very, very strong. It's become uncomfortable for the Japanese, so there's the potential for them to intervene. And the global growth environment out there looks reasonable. There should be some growth, and Japan needs the rest of the world to be growing. Because of its poor demographics, it can't generate its own growth.